First question, what is the nature of liquidated damages received by a company from the supplier of plant for failure to supply machinery to the company within the stipulated time, whether it is a capital receipt or a revenue receipt? Let us first understand the nature of liquidated damages. So liquidated damages is being recovered for breach of a contract. So when the contract is being breached, so one of the parties should pay the other liquidated damages. So why is liquidated damages is being recovered? If a person has contracted with some other person, then he might not have suffered the damages, suffered the loss. So because he has contracted with that particular person, he has suffered this loss, and therefore liquidated damages is being recovered. So liquidated damages is being recovered for breach of contract, and this must be given out in the contract at the time of entry itself. So what is the nature of liquidated damages received by a company from the supplier of plant for failure to supply machinery to the company? So there is a company and it is entering into a contract with the supplier of plant. Now the supplier of plant is failing to supply machinery to the company within the specified time. So had the company contracted with some other person, the company would have received the plant within the due time. Because the company has contracted with this particular supplier, the machinery has not received within the due time, and therefore liquidated damages is being charged by the company and it is received. Now the question is whether this particular liquidated damages which is received by the company, whether it would be a capital receipt or a revenue receipt. So the analysis of whether liquidated damages, whether it is capital receipt or revenue receipt, arises. So what is the case? It is with regard to Saurashtra Cement Limited. It is a company. So with regard to the cement company, this particular case law has come. What is the facts of the case? The SSC, a cement manufacturing company, entered into an agreement with the supplier for purchase of additional cement plant. So for a cement plant is only required to be purchased. So the purchase is with regard to a capital asset. So it is with regard to a machinery which is a capital asset. Now one of the condition in the agreement was that if the supplier failed to supply the machinery within the stipulated time, if the machinery is not supplied within the stipulated time, the cement company is delaying it process. Delaying the process, therefore it is losing its revenue because of the delay it is suffering some losses. So within the particular time it has to receive the machinery. If it is not being received within the due time, then Saurashtra Cement Limited is undergoing some kind of problems. So one of the conditions in the agreement was that if the supplier is failing to supply the machinery within the stipulated time, SSC would be compensated 5% of the price of the respective portion of machinery without proof of actual loss. So the loss actually incurred by the cement company might be more or it can be less. But what is the stipulated price which has to be received as liquidated damages? 5% of the machinery. So the supplier need not ask for the proof of the loss from the cement company, but it is being agreed that 5% of the machinery would be the liquidated damages. Now, the SSC received 8.5 lakh from the supplier by way of liquidated damages on account of the failure to supply. Now, department assessed the amount of liquidated damages to income tax. Department said that it is a revenue receipt chargeable to tax, and therefore this liquidated damages should be subject to income tax. However, the appellate tribunal held that the amount was capital receipt and High Court concurred with this view. So, there is a argument whether it is a revenue receipt or capital receipt. If it is a revenue receipt, it is subjected to income tax. If it is capital receipt, it is not. So, it went to appellate tribunal, thereafter it went to High Court, then thereafter it went to Supreme Court. What did Supreme Court tell? The Apex Court confirmed the decision of High Court. So, the Apex Court, Supreme Court also confirmed the decision of High Court that it is a capital receipt. The damages were directly and intimately linked with the procurement of capital asset. So, the asset which is being procured is a machinery. It is a capital asset. Now, the liquidated damages is directly linked to the procurement of capital asset. So, the amount received is directly linked with the capital asset, that is the cement plant, which led to delay in coming into existence of the profit-making apparatus. Because of the delay for setting aside the machinery in the company's premises, there there was a delay in the profit of the company. That is why it is asking for liquidated damages. So liquidated damages in this concept is directly linked to the capital asset, which is the cement making machine. Now, it was not a receipt in the course of profit earning process. It is not a normal liquidated damage which is received in the course of business. It is linked directly to the capital asset. The liquidated damages is linked to the capital asset. It is not in the course of profit earning machinery. So, it is not in the course of a profit earning business. It is only linked to the capital asset. Therefore, the amount received by the assessee towards compensation for sterilization of the profit earning source is not in the ordinary course of business, hence capital receipt. So first, the amount received is in connection to capital asset. So the amount received is in link to a capital asset. So the contention of the Supreme Court is the liquidated damages is directly linked with the capital asset, and it is not in the ordinary course of business. So it is this kind of damages is not directly received everyday business. It is not in the ordinary course of business. So this particular damage, this kind of damages is not received normally. It is not normally received in the ordinary course of business, and this liquidated damage is directly linked to the capital asset. Therefore, this particular receipt is a capital receipt, and it is not chargeable to tax. It is not a revenue receipt. So the Supreme Court also concurred with the view of High Court. Now, can capital contribution of the individual partners credited to their accounts in the books of the firm be taxed as cash credit in the hands of the firm, where the partners have admitted their capital contribution but failed to explain satisfactorily the source of receipt in their individual hands? So this is a tricky question. So the partners have supplied capital. So they have pumped capital into the firm. So they have accepted that the capital is from them only, but the partners are not able to explain the source of their income, so explain the source of their capital. So they have pumped capital into the firm, and the capital is being pumped by the partners. That is correct, but they fail to explain the source of their capital. So what happened? The assessing officer, assessing officer contends that the amount is unexplained credit, and he is assessing it in the hands of the firm. Now the question is arising whether it could be accessible in the hands of the firm or in the hands of the partners. So the unexplained cash credit is being assessed in the hand of the firm, and firm or in the hands of the partner is the question. So can capital contribution of the individual partners credited to their accounts in the books of the firm be taxed as cash credit in the hands of the firm? So they are contributing capital to the firm, but it is not able to be explained. So whether the unexplained credit is taxable in the hands of the firm or taxable in the hands of the individual partners, where the partners have admitted their capital contribution but failed to explain satisfactorily the source of receipt in their individual hands. Now, the assessee firm was constituted in the year 1982, and written for the assessment was in 1993-94 was selected for scrutiny assessment. Now, controversy was in relation to the capital contribution of 10 partners aggregating to 76.57 lakh. So, the capital contribution by the partners is 76.57 lakh. The assessee firm's explanation that the partners have paid various amount towards contribution of their share in the capital was not accepted since source of income was not explained. So, what should be explained? So, they have pumped in huge capital. Source of the income of this partner should be explained. Source of income of partners should be explained, but they have failed to give the source. Source of income of the partners was failed to be explained by them. So the assessing officer want to tax this amount. So he says the explanation is not correct. Unexplained credit in the books of the firm. Now, the Commission of Appeal observed that the amount credited in the names of 4 partners were valid, and that cash credits in the accounts of 6 other partners in the books of the firm were to be considered afresh by the assessing officer. Now, issue under consideration. The issue before High Court was whether the assessing officer was justified in treating the capital contribution as income of the firm. So, what is he doing? Instead of assessing it in the individual hands of the partners, he has assessed it as an income of the firm. So, now the question is whether it should be assessed under the head of the firm or it should be under the individual hands of the partners. Now, Section 60 directs that if an assessee fails to explain the nature and source of credit entered in the books of account, the same can be treated as income. Whether in this case this can be treated as income, yes, they failed to explain. In this case, the amounts ought to be treated as income is the contribution made by the partners to the capital. In a way, the amounts so contributed constitutes a very substratum of the business, and it is difficult to treat the pooling of capital as credit. It is only when the entries are made during the course of business, they can be subjected to scrutiny, where the firm explains that the partners have contributed capital. Section 68 cannot be pressed into service. At most, officer can make an inquiry against individual partners and not the firm when the partners have also admitted their capital contribution in the firm. So the partners have admitted the capital contribution in the firm. So the source of the fund for the firm is coming from the partners. So that is correct. But what is the source for the partners is only a question. So you cannot tax it under the hands of the firm. You cannot say it is an unexplained credit in the hands of the firm. Why is it so? From the firm, we know that the capital contribution has come from only the partners, not from any unexplained source. For the firm, the capital contribution has been pumped by the partners and it is given clearly. But what is the source of the partners is not given. That is what the question is. The High Court made reference to a decision in the case of CIT versus Anupam Udyog, where it was held that if there are cash credits in the books of the firm in the accounts of the individual partners, and it is found as a fact that cash was received by the firm from its partner, then in the absence of any material to indicate that there are profits of the firm, the cash cannot be assessed in the hands of the firm, though they may be assessed in the hands of individual partners. It can be assessed in the hands of individual partners, but it cannot be assessed in the hands of the firm. So what is that? The High Court accordingly held that the view taken by assessing officer that the partnership firm has to explain the source as regards the amount contributed by them towards capital in the absence of the same would be treated as income of the firm was not tenable. So maximum what they can do, it cannot be treated as income, can't be treated as income in the hands of the firm. Can't be treated as income in the hands of the firm. So what at the most they can do? At the most what they can do is can treat as income of the partners. So why is that so? It is not explained. So can't be treated as income in the hands of the firm. Why is that so? Clearly it is known that it is coming from the partners. But source of partners is not only known. Therefore, it can't be treated as income in the hands of the firm, but can be treated as income in the hands of the partners. So what they can do, the profits of the firm, the cash credit cannot be assessed in the hands of the firm, though they may be assessed in the hands of the individual partners. So this has been shown by the High Court, and that is what being vouched by the High Court also.